Good day, traders, and welcome to the Wednesday, September 18th edition of the premium video newsletter for Market Geeks. Today was a big day in the markets, and we have lots to discuss. So let's start off with the fundamentals and work our way down from there. The first announcement of the day was the August housing starts, which increased 0.9% to 891,000. which compares to an estimate of 2.3% and an increase of 917,000. Building permits fell 3.8% to 918,000, when a decline of 0.4% to 950,000 was anticipated. However, this news had very little impact on the tone of the market, as most traders were waiting to hear the Fed's decision in regards to the stimuli program. In a surprise, the Federal Reserve has decided against reducing its stimuli for the U.S. economy because its outlook for growth has dimmed in the past 3 months. The Fed said it will continue to buy $85 billion a month in bonds while it awaits conclusive evidence that the economy is in fact strengthening. The Fed's bond purchases are intended to keep long-term borrowing rates low to boost spending and economic growth. To quote Ben Bernanke, conditions in the job market today are still far from what all of us would like to see. This is what Ben Bernanke said in a news conference shortly after the statement was released. The Fed's repeated its plan to keep its key short-term rates near zero at least until unemployment falls to 6.5% from the current 7.3%. In the Fed's most recent forecast, unemployment could reach that level as soon as late 2014. The Fed was widely expected to scale back its bond purchases, but long-term rates on mortgages and some other loans have jumped since May, when Bernanke first said the Fed might slow its bond buys later this year. Bernanke had cautioned that any reduction in purchases would hinge on the economy showing steady improvement. The broad market was lower before the Fed announcement, but rallied strongly to a new high after the news. The fundamental reason why the market likes what the Fed had to say was because the Feds are going to continue putting money into the stock market and the bond market. And this will artificially keep stock prices higher and interest rates low, so the reaction from the market was as expected after the announcement came out. Most traders were expecting the Feds to begin cutting, and that was priced into the market. If the announcement was a bit different and a cut was going to happen, the market would not react very much because that's what is already priced into the market. But a lack of action is a pleasant surprise, and the next question is, how high will we go before we see a retracement? We have to keep in mind that stocks are the worst trending markets, and momentum only continues in the same direction after a breakout about 33% of the time. So be cautious, because it's more likely than not that stock prices will revisit the pre-rally levels of 1700 if the current momentum starts to stall. Remember, everything is on the table and priced in at this point, so we have to see something new to keep this fire burning. The next market I want to look at, and the one that's going to give us the most clues as to the future direction of the stock market, is the 10-year bond. This is the market that has the most direct exposure to the Fed's stimuli program, and we rallied today strongly. I'm not surprised by this rally, but remember what I always say about the bond market. It's a very choppy market and tends to trade much more in a range-bound cycle than in a trending cycle. And on a fundamental level, this actually makes sense because we don't see wild interest rate fluctuations for the most part. There's a few things I'm seeing here, and it's giving me clues that we are near the short-term high on bond market, or that we may be temporarily overbought, to put in different words. First, we're approaching a very congested resistance area immediately above us. As you can see by the chart, the 127 area, and maybe slightly above that level, has very strong resistance. Further, and this is equally as important, the RSI is now getting close to the 80 level, and this is giving me a clear indication that the buying is going to slow down in this market. What's important to understand is if the bonds peak out, it may also spell the top to this rally in the stock market. So keep that in mind during the next few sessions. The next market we want to look at that's been impacted strongly by the FOMC was the US dollar, which once again traded below the support level of 80.50 that I estimated would be the long-term support area. The market overreacted today, which is typical on days we have very important news releases. But once again, consider where the RSI indicator is right now. We're approaching very dangerous levels to the downside. I'm not suggesting that we may retrace and bounce all the way back up to the previous levels, but I do believe we will have a pullback from these levels, and this may have an impact on the stock market just as much or more than bonds. Right now, I wouldn't be surprised if we rally back to the 81 level for a test, and maybe then we will continue moving down. But such strong momentum for a one-day move is not typical for the dollar, and 8 times out of 10 leads back to a test of the previous levels. Another interesting pattern that we saw today was an island reversal to the upside in the gold market. We saw it to the downside in late August, and the decline as a result was a 125-point sell-off. Now we see it again to the upside, but with substantially more volatility. I think the next level up for gold will be the 1400 level. I'm not as optimistic to the upside as I was to the downside, and think the move will be limited because as economy improves, gold will eventually be moving lower, and market insiders who trade gold know this. I'm already seeing many gold for sale stores closing down, and I think this is just the beginning. So keep that in mind if you're trading gold to the upside. Be very cautious. The final market I want to look at today is the euro, and we took out the high today. But we need to look at the big picture and the fact that the euro is trading inverse of the dollar right now, and the dollar is approaching very oversold levels. We also have to take into account the fact that the euro has substantially more to go on the upside before approaching the 137 level. This is the next resistance area, and eventually I think we will get there. But don't think for a moment the momentum in the euro is going to move straight up. So the question is, where do we go from here? The Feds are working extra hard in keeping the US stock and bond market as stable as possible. And today demonstrates that they didn't want to take any chances and ruin what they built in the last several months. And what I said was very important. However, nothing is forever, and within the next few months, we will begin cutting. And it's not a possibility, but a strong probability at this time. Hedge fund managers are aware of this. So are large mutual fund managers. These large funds move the markets. Little by little, they will begin liquidating positions to lock in the gain they have for the year. September is not over, and typically it doesn't end well. Right now, I'm going to be monitoring the bounce from these levels and see how far the bounce will be against the trend. If we can hold near today's closing price on the stock market without giving back too much, I may change my mind. But the way I see it today may be an overreaction. There's no setups for tomorrow because of the wild volatility we saw today. The stop loss levels are too far away and the risk per trade is just too high. I will update you tomorrow midday as usual. Have a great night, everyone.